Welcome back, guys, CryptoFollow channel. In this podcast, I want to talk about a consistency in trading. At the heart of success in the financial markets lies a powerful concept: consistency. Today, I want to dive into what consistency means in trading, how it functions, and how mastering it can transform your approach to the markets. And I'm always honest with you. Now, only maybe the last 2 years, I step by step build my consistency. Before, I made a lot of mistakes. I lose the money, and maybe for me it can be the big money because everybody got a own budget, own deposit, capital, and for someone it's not a big deal like to lose the 100K. For someone a big deal it's to lose the $100. That's why, guys, don't pay attention too much for the amount of money what you lose. Pay attention more for the process and what you learn. Because if you can operate the $100 budget and feel nothing or feel something or learn something, at the end, when you will operate the capital with 100K or even a million, you will do absolutely the same things what we will talk today in this video. And it's helped you a lot. In the markets, we know the price movements are visually represented by the green candles during the upward trends and the red candles during the declines. Pretty simple, right? This fluctuation form recognizable patterns or the chart formation that traders analyze to uncover opportunities. Technical analysis doesn't work because it's random. I'm not agree, because technical analysis it's a tool that help us identify these patterns, providing a strategic advantage or edge that guides our trading decisions. You might adore the technical analysis or you might find it frustrating, but it's the cornerstone for structuring our trading approach and building a system that give us an upper hand. It's a tool. So yes, TA, it's a simple tool what you can work with. However, the simply recognizing the pattern or predicting the price direction isn't enough. True account growth stems not from the market analysis alone, but from the mastery of trade execution. It's how we act, our discipline, decision, and risk management that ultimately determines our success at the end. The consistency is like a rising curve of your trading capital. This curve, it's not a straight line. This curve represents your account balance over the time, up and down smooth, much like a robust uptrend in the stock indexes. So the stock index always going up. It's a forever uptrend because we are in a progress, the humanity in a progress, not in a regress, right? For consistency, profitable trader wins outweighs losses at the end. So simple math. And risk isn't escalated after a string of setbacks. While losses are inevitable during the growth, they remain minor and are simply part of the trading journey. This concept ties into the idea of dispersion or variance, a mathematical phenomenon you can't avoid in trading. Think about trading and about this consistency like flipping a coin. So here, I got a coin with yes and no. Right, so yes, it's a metal coin. So you know the odds. So yes can be the 50%. And yes, it's a 50% chances. But in a small sample of 10 flips, so for example, I 10 times flips this token, and yes might appear only 3 times. Does this mean that probability has changed? Of course not. It's just a variance. So you open 10 trades and you know the probability is always 50-50. Always. Just keep in mind that always, no matter what happened on the market in the world, it's always 50-50 chances. But if you open trades at 10 times and you get a profit only 3 times, does that mean the probability has changed? Of course not. And you can just increase your sample size how much you will trade. And over 100 trades, 100 flips, the yes, maybe at the end, will hover the close to 50%. The same principle applies to the trades, so consistency emerges over a series of trades, not as single outcomes. So you might see the steady growth and profitable trades, but if this success relies just by luck rather than a systematic approach, it's unsustainable. An inconsistent trader might risk the large sums at the ends, closing trades prematurely for small gains as soon as the price moves in your direction. Eventually, this reckless approach leads to the devastating loss in a single trade. And like I told you before, you can open 9 trades in profit by luck, but the last trade can erase all your progress. The root of these issues isn't the market or your trading system. It's just simple psychology and risk management. Inconsistent traders often chase losses, taking too much risk, right, to recover your loss, right, only to repeat the cycle until their account is wiped out. Many mistakenly blame the market condition, emotional triggers, risk management principles, or the assets you trade. Yes, assets what you trade, it's also play the big role, because if you trade the Nvidia, for example, or the gold or the BTC, it's a big difference if you trade memes. Never blame the market. So it's all about your mindset, your personal mindset, your personal decisions, and the discipline. So here's by my personal experience, 4 case strategies, what I mark and note for myself, just personally for myself. I need to develop a trading edge. You need a clear understanding of market behavior to spot opportunities with higher probabilities of success. So it's only that probabilities. So there is no grail, no magic pill, no alpha, nothing. So every trader should craft a personalized system that aligns with their psychology, time zone, time frame, and the traded assets. So if you like trade and you feel comfortable with the trading the meme tokens with the 20x leverage on a Binance, for example, and you feel comfortable on a 5-minute time frame, and on a distance you're profitable, congrats, you find your some system. This edge is your foundation of consistent profit. So just repeat this action every single week, every single. Many traders struggle with probabilistic thinking because our brains aren't wired for it. Imagine a series of 10 trades where your system yields 5 wins and 5 losses on average. You accept the possibility of consecutive losses, but when stop losses hit, doubt creeps in, leading to impulsive decisions. Shift your focus to a long-term series of trades, not individual outcomes, and embrace the randomness of the market. Next one is overcome limiting beliefs. When you open trades, you have to understand it's a possibility to get a stop loss, but you have to believe in a possibility to open right trades regularly. Because if you always think about potential losses, you program your mindset before the trading sessions. You start fighting with your brain. And your like main goal now, it's not to be the profitable. It's not to whip it out your account. Next one, it's a master emotional control. Consider euphoria. For example, when I got like 5 trades in a row wins. I understand, because I come back to the first point and I understand it's just the possibilities and the probabilities. And my next trade can be the stop loss. So I just reduce that emotional euphoria inside me, right? And I feel nothing. I feel absolutely nothing, because we already talked about it. That loose streaks give you the, like a catastrophic losses and the mental issues, right? But wins streak give you the overconfident on your trades. So you have to just be on a balance, be on that corner of that coin. I got also the common trading mistakes and how we can avoid them. First one, it's hesitating too long before entering. We need to plan our trades, but sometimes you plan at your entry, you plan at the stop, and you plan at your take profit, but doubts strike at the price nears your entry. It hits your entry, but you wait too long and you miss the move. Then jump in too late in that trades, and you start create a poor risk-reward ratio with a distant stop loss and a minimal profit potential. Next one, it's exiting too early. Impatience drives you to enter prematurely, fearing a missed opportunity, only to realize the risk-reward doesn't justify the trade and leading to losses at the end. Sometimes you open the trade, and we talk about the risk-reward ratio when we can't trade even 1-to-1 risk. But sometimes the people open trades 1 to 0.5 reward. You get a 0.5 reward, you get a 0.5 reward, 0.5 rewards. At the fourth trades, you open again trade and you get a stop loss, and it's erase all your previous profit. So you have to enter in time and exit in time. Just wait. It's not setting risk in advance. Failing to predetermine risk, whether by skipping stop losses or moving them. You know, when you open trades, you figure out my risk only 1% for this trade. When the price going down and almost hit your stop losses, to avoid that 1% stop loss, you start move your stop loss down. And now your stop loss not 1%, but 2%. With a 10x leverage, it's 20%. But the main goal was to open trade with a 1% because you make a deal with yourself. And when you all the time trying to ignore, trying to not get that stop loss 1%, you always will be moving your stop losses down. And at the end, your losses will be much, much bigger than you can expect at the end of the week. Refusing to accept losses. You adjust stops to avoid closing at loss. Next one, it's taking profits too soon. Exiting profitable trades early for small gains might feel safe, but it's unsystematic and the foster gambling tendency, stunting the long-term growth. Or you can letting the profits turn to losses. Moving take profits further in hopes of bigger gains can backwire, leaving you with no profits if the market reverses. The last my trade was with the dog wave hat. I opened trade almost at the bottom at 56, so we hit the 55 cents. I opened the trade at 56 and I make a deal with myself, so I will close that trade exactly at 65 cents. And I close that trade. The price go higher to the 70 cents. I feel nothing because at the end, in the next few days, we anyway come back to 58. Moving stop loss too close. You know, it's a shifting stop loss to the break even after minimal price movement might seem protective, but it's risk early exits, especially if the market reverses slightly before continuing in your direction. These mistakes stem from believing you can predict the market perfectly. A lot of people want to be right more than they want to be profitable. But at the end of this video, I want to share the core truths, maybe a hard truths, which helped me personally. First one moment, it's anything can happen anytime. Sincerely believe the market is random. Every moment is unique with no identical conditions, only patterns with varying probabilities. So your edge indicates one outcome is more likely, but you can't predict each trade's results. Next one, you can't control the market. Focus on controlling your mindset and beliefs, adapting them to market condition. not vice versa. So, in simple words, reduce your expectation, embrace uncertainty, trust your system's long-term performance. That's why you need the trading journal to understand your system works or not. If not, what you can improve on a distance. Distance, I mean, it's a few months, not just a few days. You build some journal, you trade 1 week, you're profitable, and you trade and start increasing the deposit, the size of deposit. At the end of months, you're in losses. So it means your system doesn't work. Next one, prioritize the discipline over prediction. Like I always repeat, I wish to be always wrong, but be profitable with my predictions. Rather, I will be always right on YouTube, but lose the money at the end on my real deposit trading account. And the last one is learn continuously. Regularly assess and refine your system, psychology, and risk management to close the gap between the potential and results. Consistency isn't just a goal, it's a foundation of sustainable trading success. By developing a trading edge, thinking probabilistically, overcoming the limit beliefs, mastering emotion, and avoiding the common pitfalls, you can turn volatility into steady growth. The market randomness is a challenge, but also an opportunity. Embrace it, learn from it, and build a mindset like a professional casino, not a reckless gambler. Guys, I hope you like this video. Subscribe channel, hit the like button, hit the notification button. Don't forget to join my Telegram channel. See you next time, guys.